Welcome, everybody, to Building My Legacy podcast. Today, I have with me today Rich Kasparian. He has a company in Garden City, New York, it's financial planning, helping people look at the next chapter of their life. What do they do with their investments? What have they planned with their insurance? If they are going to retire, what does that mean? What does it mean with succession planning? So all the things that we need to look at in terms of growing a business for our future and then being able to walk, sell, whatever we want to do with that. So on that note, Rich, I'm going to turn this over to you. You can share a little bit about your background, what brought you to doing this, and then we'll talk about what the things are that people should be thinking about and planning for.
Thank you, Lois, and it's great to be on your podcast. Appreciate it. Again, my name is Rich Kasparian. My company is Garden City Financial Group. We're based out of Garden City, Long Island in New York. Our customer base is throughout the country, so it's not really just limited to one region. Years ago, I was back in the old days, I worked on Wall Street for many years. Then I transitioned to Smith Barney, which now was taken over years ago by Morgan Stanley. I was there for many years in City Smith Barney. I then transitioned about 11 years ago into my own practice, Garden City Financial Group. And our basic goal is to help business owners, small business owners, and individuals plan for their future. But more importantly, look at the market as a whole. And it's not just always about hoping things go higher. But one of the goals that I built my whole career on is trying to find ways to protect customers' downsides if things should ever, turn ugly, which they do. And also we look at insurance planning, business succession planning, long-term care, retirement, and many other aspects of planning.
So, Rich, those are huge areas. People spend a life growing and building a business and hoping that they have something to fall back on or for their retirement. What are the top three things that you think people should be thinking about as they prepare for retirement?
I think there are a couple of aspects as a whole in planning and for the future, and even investing as a whole. Many advisors out there, they sort of had this theory or this concept of a customer has or a client has X amount of dollars they want to put away for the future, and they'll basically give them a plan for every dollar of that amount of money. I pride myself in being somewhat of a contrarian. I work backwards. So the first thing I'll always say to a customer is, how much money do you need to leave in the bank for safekeeping, for the rainy day, for those extra things that pop up? Because the goal really is, if you're going to invest money, especially for retirement, you want to be able to leave it there and grow. So that's the first thing that I always, impress upon customers. Now, for everyone, that dollar amount is different. Some people it's $5,000. Some people it's $100,000. Some people it could be $10 million. It's all predicated on what people are looking for. So once we sort of have that, then I break things up into two remaining piles. The second pile is the middle term goals. Let's say a 3 to 6 year goal for investing. And then the final part of it is the long-term or the retirement part of investing, which is the long-term retirement. This is the money I don't want to touch until I retire. So those are sort of three avenues that I start with as a basis. And in terms of what a customer or a client would be looking for, do they plan to remain, living in the state that they're in? That's number one. Number two, when do they actually see themselves retiring? At what age? Years ago, people were retiring at 55. I mean, those days are long over. People are working much longer now. And then the third thing is, what is sort of their stomach for risk tolerance, or the stomach for the ups and downs of the market. So I think once we tackle all of that, then we can build a plan going forward.
So, Rich, as you work with people, what are some of the biggest mistakes people make?
One mistake is this concept that we hear all the time, especially on TV, the talking heads, of diversification. I want diversification. Um, in concept, it's a good theory, but in practice, it rarely happens. So I'll give you an example. Someone might have a retirement plan and they get this little booklet, maybe at work, or they look it up on the internet, or an advisor says to them, we're going to diversify your portfolio. So they pretty much like a dartboard, they say, okay, I'm going to take this growth fund and I'm going to utilize this value fund and this bond fund and this mid cap fund. And they build this sort of little portfolio, let's say, amongst their retirement and assets. But when we really drill down, and this is where one of the things I do when a client, summons me on the website or they need help, one of the things we do is we evaluate their portfolios to see how they're invested and what they have already. On our website, by the way, is www.gardencityfinancialgroup.com. But when you drill down on these funds, in many cases, it's very ironic, they all own the same companies. So I've had customers at times, or clients at times, send me statements from different accounts that they have, and they say, I'm well diversified. And when we drill down and we look, they might own 5 or 6 funds. They all own Apple. They all own Microsoft. They all own Google. So at the end of the day, a fund might have a different title, or maybe even be a different company, like Fidelity versus Nuveen, but yet they will all own the same fund. So one of the things I look at is, especially in a review, is we want to make sure, are you really truly diversified? And that's a sort of a key challenge, and sort of a thing that people don't look at, deeply when they're trying to figure out, how do I go forward and how do I invest?
So, diversification gets to be a problem because companies are merging all the time. They're being acquired, and those changes have a profound impact on your portfolio, and you may not realize it, right? So it's almost as though you need to do a review of your diversification within your portfolio periodically to stay on top of that.
That's correct. Yes.
Okay.
Yes, that's absolutely correct. I mean, generally speaking, we try to do reviews with customers. It all depends. I have some customers who only want to do a yearly review. Some customers we look at every 6 months, and some customers we might look at quarterly quarterly reviews. It depends on a person's schedule, and if they're busy, and what the situation is. But yeah, you definitely want to do a review. One of the most important things, and how we pride our business, at Garden City Financial Group, is we really heavily focus on investments, products, or programs that protect customers' downsides. So we know that you can be well diversified, but if the S&P 500 is down 30%, you'll be down 30%. Or more if you're even more aggressive than that. But there are many programs out there now that I've been utilizing for years, and actually they've improved little by little over the years, where you can be invested and you'll have protection of a certain percentage on the downside of the S&P 500 or the Russell 2000 or the Dow Jones. So, and there are also other programs out there that provide protection along with guaranteed income for retirement in the future. So So yes, diversification is important. Reviews are important, but one of the really key factors nowadays is utilizing programs that can really help the downside. So for example, if you have a program that's protecting your downside, everyone else is down. You might be down, but you might not be down as much during those trying periods.
So, Rich, why would somebody not have downside protection?
In many cases, because people, will typically invest in sort of the old fashioned or the normal way. They'll buy stocks, they'll buy mutual funds. We hear a lot about obviously ETFs, which stands for exchange traded funds. Um, and generally speaking, if you're buying those assets individually, they don't come with any kind of downside protection. The same as a typical 401k at work. They typically don't come with downside protection, which is a big part of our business because many times when people do retire, they then want to roll it over into something that provides that sort of downside protection. And to answer your question, also, some of the programs that are out there are more complex, that maybe advisors aren't presenting or people aren't sort of finding them on their own. But they've been out there and they've been out there for years. Some are available through investment companies, some are available through insurance companies.
Got it. So, as people are planning for retirement and they're looking for a financial advisor, what are the questions they should be asking of that financial advisor when they're seeking them out? How do you discern whether or not you've got the right one for you?
That's a really great question. Because we often kid sometimes when I speak to clients, if you talk to 10 financial advisors, you might get 10 different opinions. Um, um, I think the first opinion or the first thing you want to find out is what is the philosophy? What is their overall philosophy on the market? If their philosophy is we buy this to hope that the market goes higher, well, that's not really a philosophy. What is the concept on the market? So I'll give you an example. Let's take, because this is foremost on people's minds. Like, let's see what just happened with GameStop a couple of weeks back. So the big boys, the hedge funds, the word was they were going to short GameStop and some other stocks like it to zero, or basically put them out of business or close to it. Now, for those of you who don't know what shorting a stock is, it basically is a bet against the market, a bet against the company that it will go down. So it's totally legitimate. What you're actually doing, not to get so technical, you're borrowing the stock from the house and selling it first at a high price. When it drops, you buy it back at a lower price. The difference in the middle is profit. So it's obviously the opposite of when people buy a stock and want to go high. So, but coming back to it, so the big boys were going to bring the stock down. And then a bunch of gamers, let's call them on Reddit, said, no, you're not. You're not going to bring this stock down. All the little guys are going to buy it. So the little guys bought it. And it created what we call a short squeeze. What a short squeeze is when the guys own it high and want it to go low, but the stock now keeps going up. The more it goes up, the more money they lose. So they have to bail at some point. Well, lo and behold, those hedge funds lost billions that day. But the hedge funds then came back, started crying on politicians' laps. All of a sudden, politicians who are supposed to protect the little guy are protecting now the big guy. And the big guys then started to punish the little investors over those next few days. So my point is in all of this, philosophy on the market is I tell customers straight up, the market can go up, but it can also go down. There are things in the market that make absolutely no sense. Sometimes you'll look at the news, the stock should go up, it goes down. Sometimes you'll look at the news, it goes up when it should go up. We just never really know. So you have to prepare. So philosophy is king. I say that all the time. Customers have to know that the market is sometimes somewhat of a game that nobody really knows behind the scenes what totally is going on, especially when the big boys are pulling the strings. So philosophy is number one with an advisor. What's their perception? Yeah, sure. Go ahead. I'm sorry.
There for a moment. So philosophy is important. I think most people understand the market's going up and down, but then you have to have a philosophy around that. Is the philosophy about how you manage risk? Is the philosophy about how you, when you decide that it is no longer worth holding, how do you create a philosophy out of that?
It's really, I believe it's the managing risk. So so one of the things when we finally come up with a plan for a customer, and we're going to present it and move forward with a plan, I'll generally talk in many cases about the downside first. So normally, what most investors are used to hearing is, what's my profit? What am I going to make? How well am I going to do on it? In many cases, with the programs that we utilize, like I've said before, downside protection, income for life, I'll talk about worst case scenarios. So customers could see, well, if I own this program, what is my worst case scenario first? Then we'll talk about the growth position. So I think that's sort of where it is. It is it's the philosophy on downside risk. And also sometimes when things are dropping, do I pull the plug? Don't I pull the plug? I mean, there are scenarios like that. But if you have your portfolio as we do at Garden City Financial Group, for most of our customers, unless the ones who just want complete risk, you feel good. You could put your head on the pillow at night knowing that when you have assets that have downside protection, some sort of downside protection, you generally will sleep better.
Got it. Okay, so the one thing you look at is philosophy. What else do you look at when choosing an advisor?
What is their array of programs or products that they're discussing? Um, Wall Street over the years has become somewhat compressed. And what we've constantly hear now on Wall Street is, I'm in a managed account, I'm in a managed account, I'm in a managed account. A lot of these managed accounts are really not that managed. A lot of them rely on computer models that kick things in and out of the account. So they're really not managed. I always use the analogy on this managed account concept. It's like you were sold the private country club and you end up at the public golf course. So I think an open architecture as your financial advisor is the key. If someone is doing a lot of transactions, a managed account is perfect because the fees are set at sort of one fee. If someone is not doing a lot of transactions, that might not make sense because they're not doing a lot of back and forth transactions that could add up in fees. So that's sort of another issue that I think is important.
Okay, what else?
The third thing I think of is does the advisor talk about anything other than investments? Are they talking about insurance? Are they talking about, do you have an updated will? Are they talking about long-term care? Are they talking about business succession planning? Are they talking about beneficiaries and beneficiary updates on accounts? Families have a lot of times changing dynamics. They do a will and 5 years later, something changes. or someone gets married, or someone gets divorced as a beneficiary. So I think those are important keys too, where the advisor should be involved in many aspects of, I've sometimes often said to people privately, customers or clients tell me things that they don't tell anybody else because, they need it in confidence, especially in many cases when it comes to who's going to be my beneficiary, what percentage should I put down, or who's going to be in the will. And one of the things we do here is we will coordinate with your accountant. We will coordinate with your attorney or lawyer while you're trying to do some of these things. On many cases, I have clients' attorneys call me and ask questions. And in many cases, I deal with their accountants, especially during tax season.
So what you're really saying is, if you want a good plan for the end of your life, for retirement, you've got to have somebody who has a comprehensive look. So it would be like having a internist who would take care of all the problems, medical problems that you have, as,
Yeah.
as an example, right? Who can oversee and make sure that there aren't pieces that are being left out or forgotten. Am I correct there?
Yes. Yeah, it's sort of we'll use the sports analogy, the quarterback, so to speak.
Okay.
You really kind of want the person to be a quarterback, and also legacy becomes part of it. Knowing also that family members down the line will have access to the advisor as well. In terms of if they have questions on their own things, or God forbid their parent should pass away, what's going to happen? They need to be in the loop. So yeah, I think all of that coordination is the most important thing.
So when you sit down with people, one of the questions I'm sure people ask of you is, what do they really need in order to have thoughtfully prepared for retirement? And obviously, that's going to depend upon a person's income and what they have in terms of assets. And but are there formulas that you follow in terms of how people should plan, how they should think, and when they're ready?
Yeah, I mean, there are formulas, I would say, for investing. There are also formulas for how much insurance people need. Um, it, it, the formulas on investing or retirement do become a little difficult because most people that you talk to, many do not have real that we do come across a lot. So again, working backwards, what's your Social Security payment going to be? At age 62 or 66? Does it make sense to take it at 62? Does it make sense to take it at 66? So that's one thing. Do you have a pension? Do you have a 401k left over from an old company? Do you currently have a retirement, and how much are you putting into it? Do you have any additional IRA or retirement accounts out there? What's your current income now? Do you plan to live here, or do you plan to move somewhere less expensive? So once we kind of determine all of that, then we have to put a plan in place with what they have in front of us to determine from this point on, this is how we can grow and protect what you have currently. But from this point on, this is what we think you need to put away to enjoy sort of a comfortable lifestyle. Now, on the insurance plateau, that's a little bit different. For life insurance, most people are very underinsured. So, for example, if someone is 40 years old and has three young children, for them to have $1 million in life insurance is not unusual and not really too much. I come across a lot of people who, they have 100,000 or 200,000. They have a family of 5. They have a mortgage with 3 or 4 or 500,000 on it. And the idea is on the insurance, there is a pretty specific formula. Do you want the insurance to pay off the house? Do you want the insurance to have income replacement that's lost for a couple of years? And do you want insurance to take care of education planning? If someone should, you know, lose their life at an early age. As people grow older, kids are out of the house. Maybe they don't need much insurance. Then you could sometimes look at reducing some of what they have. And insurance then starts with a will. Do you have a will? If something were to happen, nobody wants to talk. And I have sort of an old joke that I've said to customers: just because you do a will and life insurance, it does not mean you're going to die. You know, but there's that sort of looming superstition about it. But those are the two aspects of investing and insurance.
So, Rich, we've covered a lot. Things we've left out that you think are important for people to think about that we've missed or that's been incomplete?
No, I think you've been great. By the way, thank you. I appreciate really, Lois, being on your podcast. It's been terrific and informative. Our website is gardencityfinancialgroup.com. So if people liked what they heard or sort of my philosophy on investing or retirement, you can catch us there. Also have a YouTube channel, Garden City Financial Group on YouTube. If you have an interest or you would like us to review your portfolio or have questions, you go to www.gardencityfinancialgroup.com. You hit the Contact Us tab, and you can type in your information, and someone would get back to you, soon. And again, what we could do is we could help people review their portfolios, kind of see what their goals are, and then take it from there.
Okay, super. Rich, so we will put that information in the show notes of the podcast so people can look you up, or it'll be right there for them, the information that they need. So we encourage people to do that. And also we'll link to your YouTube so that people can go there directly as well. So thank you so much.
Thank
for
you.
Being with us today, Rich. And for those of you who are listening to Building My Legacy podcast, this is another step in that whole legacy building. What are you doing with your money? How are you planning for it? And how is it being organized? So please remember to also visit our website at buildtomorrow.com. Thanks everybody for listening. Thank you for watching my video. Don't forget to like, subscribe, and click the bell button above. Leave comments. We'd love to hear what you think. And visit our other social media links as well. Thanks much.